In the scorched landscapes of California, a little-noted provision of the Republican tax overhaul has property owners worried about being burned twice, once by the wildfires that have destroyed thousands of homes, and then again by being denied a tax write-off for their losses. But there is much confusion about the legislation's actual effects. Here are answers to some of the vexing questions. As things stand now, taxpayers who suffer what are called casualty losses that exceed 10% of their adjusted gross income can deduct the excess amount, to the extent that it is not covered by insurance. The Internal Revenue Service says casualty losses can include those from natural disasters like hurricanes, tornadoes, floods and earthquakes, as well as losses from fires, accidents, thefts, or vandalism. The deduction helps soften the blow for people who are uninsured or underinsured, and many homeowners' policies do not cover the full value of their property, according to Michael Simkovic, a professor of law and accounting at the University of Southern California. Taxpayers nationwide deducted $1.6 billion in 2015 for losses from natural disasters, the IRS calculates, and much of that was in California. The state's Department of Finance reports that in 2015, nearly 100,000 federal returns filed in California claimed casualty loss deductions totaling about $700 million. Both versions of the tax legislation now moving through Congress would take away the deduction for personal losses in wildfires. The House bill would eliminate the casualty loss deduction entirely. The Senate version would retain it only for losses in federally declared disasters, and wildfires have hardly ever been so declared. No. The new tax law would not take effect until 2018. People whose homes were destroyed in 2017 would still be covered by the old law. They would, however, have to tally their uninsured losses and claim them on their 2017 return, the one they must file by April 15, 2018, unless they get an extension. However, damage that occurs on or after January 1 would fall under the new law, and would not be deductible, though there could be some exceptions if the House version of the legislation is approved. Democrats have complained that these provisions are especially unfair to California, which is more prone to wildfires and earthquakes than most other states. But losses from hurricanes, tornadoes, floods and mudslides would not be deductible either, so the effects would be felt in many red states as well. Congress can pass special legislation to provide tax relief for victims of particular disasters, as they did after this year's major hurricanes, waiving the 10% threshold for casualty loss deductions and allowing early withdrawals from 401(k) retirement accounts without the usual tax penalty. Some Republican lawmakers have said they would approve a similar plan for victims of the California wildfires. Even so, Gov. Jerry Brown and Democratic lawmakers have said the repeal of the casualty loss deduction would make it much more difficult for Californians to bounce back from the state's inevitable disasters.